Sure. All right. So, good evening once again, everyone. I trust we are doing well, and I want to actually hear from you. How are you doing? Actually, how is everyone doing? If you can, please.
Are doing great.
You're
Good
doing
evening.
great. Okay,
Yeah,
Miss Jennifer.
yeah.
Nice to hear that you're doing well. Anyone else?
I'm good, sir.
Precious. Awesome. Awesome. And I hope you are not just giving me generic responses. I hope we are actually really doing well. Okay, so that I don't take too much of our time, let's get into the class today. Um, I'm welcoming every one of us back, for day two of this FinProp Investment Class. And for those that were here yesterday, you already know that you're on a journey. And if you're just joining, you actually picked a good day to show up, and I want you to celebrate yourself. Please celebrate yourself with the clapping emoji. All right, so like I'm saying, you found a very good day to join us because today we want to talk about something that everybody wants, but it's not something everybody can do because they do not understand how it works. So yesterday my super dad Femi, he taught us on finances. Yes, he taught us on how to master our finance. How many of us were present yesterday? Um, let me you can use an emoji or raise your hand. Okay, is does anyone want to share one or two things they learned yesterday so that I can ensure that we're actually paying attention? So please, just one person or two persons or two people. What you learned yesterday? No one. No one is responding. Miss Rafiat, you said you were around yesterday. Teach us, ma. Wait, can we hear me? Because nobody is reacting or speaking all of a sudden.
Yeah, sorry. It's my network.
Okay. So, what did you learn from yesterday's session? What did you pick from yesterday's session?
Yeah, I learned budgeting for financial success. I learned how to build financial resilience, how to manage debt responsibly, and building long-term wealth. Strategies for building long-term wealth.
Beautiful, beautiful, awesome. Does anyone else want to go in 5 seconds? Five, four, three, two, one. Assume.
Okay, I'll go.
Okay, Oladamola, go on.
Part of the things I learned yesterday, I learned financial habits of builders, how to like live below me, planning before you spend money, also how to invest with patience. Also, have a prepared monthly budget and track your expenses.
Mm-mm. Sharp, sharp. Everyone, please, a round of applause for Rofiat and for Damilola. People are very good students. Okay, so with that, I wasn't necessarily able to join the session because of one or two things, but I know that Femi must have done justice to mastering our finances to take control of the money that passes through our hands. And that was a very important discussion because that's the foundation. You cannot multiply what you've not mastered. A, a person that cannot manage 50,000 naira will definitely mismanage 50 million. So when we are able to sit back and look well, we realize that amount is not the problem. It's more of a problem of mismanagement. One exercise that paints this well to me is that I tell people that if you actually look through your account statement, your bank statement, you realize that at one point or the other, you have been a millionaire. At least most of us. You look at your bank statements, you look at money that came in, went out, and you realize at a point you were kind of a millionaire. So what happened? That is where our conversation, or one of the areas our conversation is going to touch on tonight. We're taking the next step. So mastering your finance is like you holding money, but when we're now talking about multiplying, it's more of growing money. So I will do my best tonight to give you an investment blueprint. And that's basically talking about the principles and the practical steps that can turn whatever you call income into wealth. So, just to ensure that we are interested in this conversation, yeah, I want everyone to drop in the chat what is one word or one sentence that comes to your mind when you hear investment? What comes to your mind when you hear the word investment? I'm looking at the chats to see our responses. What comes to your mind when you hear the word investment? It could be a word, it could be a sentence, it could be a phrase. But please, Gloria, thank you. She said building wealth. Lolia said money multiplication. Femi said making wealth. Okay, these are beautiful responses. Uh, if I say mine, it's going to sound somehow, but that's on a lighter note. Mine, like MINE, said delayed gratification. Jonathan said money working for you. Beautiful, beautiful. You guys have a right idea. Okay, Precious said putting your money in a place to get revenue. Now the chill, man. All right, so you are all correct. Yeah. In the conversation tonight, the first point I really want to make is to give you a why for investment. It is good to save, but if you only save, you are losing money slowly. And that slowly is even relative because if you are in a place like Nigeria, you might be losing money fast. And one of the little exercises I do is that in 2020, for example, if you add $1, it was 500 naira. Like, so it was 500 naira to a dollar. So if you add, let's say maybe like $100, that was 50,000 naira. If my calculations is not wrong, 50,000 naira, yes. Now, if you have that 50,000 from 2020 till today, and you now say, oh, I've saved this 50,000 naira, let me convert it to dollars. As at today's rate, you might be having maybe like $38 thereabout. And so by not increasing income or anything, you have lost money by just holding onto it. So saving is good, but the end of savings is investment. That is why we save. Saving alone is losing slowly. Just like the example I made now, if you save money in Nigeria and you don't do anything with it, inflation will quietly swallow it. So let's say peradventure we have someone on this call that, even though this is quite, I don't believe we should still have anyone, at least in this age, that is doing this. But if you find you are someone that keeps naira maybe under your pillow or even in a regular savings account, if you do a calculation, you realize that you are losing money every single year. Saving is a good culture. Saving preserves discipline, but it does not preserve value. And that is why investment as a whole is not a luxury for people that are considered rich. It's a survival skill for everybody that is earning money in this economy. And sorry to Jonathan, my Gada brother, it seems as if it might be tailored so much to the Nigerian audience, but the principles therein you can still find it useful for you for yourself. And so I was saying that I want to make a case of why you should invest. And there are three major reasons in my books for why you must invest. Number one is inflation. Your money must grow faster than prices are rising. Otherwise, even when you are standing still, you are unconsciously moving backward. I will repeat that for the sake of those who might be taking notes in one way or the other. Your money must grow faster than prices are rising. Otherwise, you are moving backwards even while standing still. Just like the example of the $100 that moved from being 50,000 naira, that moved from being $100 to $38 without doing anything. You lost. So number one reason you must invest is inflation. Second one is time. And under the conversation of time, I'm talking about you not having energy forever. You won't always have the strength that you have now. You won't always have the kind of time you have on your hands now. I think I was seeing a quote sometime or an infographic or something like that of how if you have the old people have money but no longer have time. The young have a lot of time but no money. So each one is now trying to exchange what they have for what they do not have. So I'm trying to tell you that you will not have energy forever. Investment is how your money keeps working when your body cannot. Then the third one is legacy. Legacy. And for those who are a bit familiar with me, you would see that I've brought my pattern into this conversation again because everything I do is, in a sense, legacy minded. Salaries, for example, will end with you. It is assets that will outlive you. So if you want to leave something behind, scripture says something like, good man leaves inheritance not just for his children, but for his children's children. So that means what qualifies you as a good man according to that verse is the fact that you can Save something, invest something that will reach your grandchildren. If that is going to be your plan, you must build something that stands without you. And savings doesn't do that. Investment does that for you. So if you are a salary earner, it's not many some people say, oh, salary is the what they call that thing? Is what they give you to forget your dream so that you can work on another person's dream. Not for when you are actually hungry. Better collect the salary and use it to survive while you are working on your dreams. So your salary is a seed. It's a seed. And the mistake many people make is that we eat our entire seed and we keep wondering why there's no harvest. And I know the economy is tough. I understand the fact that it is not easy. But the first step, yes, is saving. You must separate money. Yeah, it doesn't matter how little you earn, separate at least 10%. Please, at this point, I'm begging. So that those three reasons are basically the why I believe you should invest, amongst other things. But because of time, I will not go too deep. But those are enough reasons for you to start investing because one, inflation, two, time, and three, legacy. Then, in my little journey of life, which has included consulting, teaching, mentoring, blah, 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 whatever you want to put in the figure, I've realized that there is a mindset that backs um, the actions of a kind of people. There is always, many times, an hidden mindset as to why a group of people behave the way they behave. And so, in the same vein, there is the investor's mindset. And so, before I start talking about maybe if I eventually decide to where to put your money, you would need to do a little fixing of how you think about money. Because investment is 80%, or no, let me say like this, investment is 20% mechanics and 80% mindset. For those who might have done forex or crypto, you would have heard that a larger portion of trading is actually psychology. And so bringing it into the game of life, 80% of investment is psychology, is mindset. So there are little mindset mindset shifts that must happen for a person to be or become an investor. The first shift is shifting from consumer to owner. Shifting from consumer to owner. And this part is one of the greatest problems I have with third world countries, particularly most of Africa, because I have a, for lack of better word, burden for Africa. This consumerism is one of our greatest problems because we consume from every other part of the world and find it hard to produce. Thank God it's even getting better now. We are beginning to export talent and all beautiful, all amazing. But still, majorly, we are consumers. And the only place I know that consumes without giving out is a refuse dump. So, yes, I'm I'm equating whoever is just a consumer that does not hone something, that does not give back something, as a refuse dump. Anyway, follow my thought process. Consumers, in their behavior, they buy things that lose value. And for those who are familiar with terms liabilities versus assets, what that means is that they buy liabilities. But owners buy things that gain value. Owners buy things that gain value. That's one of the shifts that must happen. You must become conscious that your spending is more towards ownership than it is towards consumerism. I'm not saying don't consume. Of course, all work and no play makes Jack a dull boy. You must play, you must have fun, you must enjoy. But let it not be at the detriment of your future. Simple as ABC. Enjoy your life as you should. But don't be so lost in enjoying your life that you consume it all. Another example of what the consumer does is that the consumer buys the latest phone, whereas the person that has an owner mindset buys shares in the and he buys shares in the company that is making the phone. And this line is one secret I used to forget to share it with even my mentees once in a while, but I think I've shared it once or twice with them. And it's the fact that anytime you're feeling that urge, that hope, you want to buy this, buy that, why not instead invest in the stocks of that company? So now, firstly, it's going to teach you patience. And eventually, if the money you invested in the stocks of that company, let's use Apple, for example, you want to buy the latest iPhone, beautiful, good. However, if it is not so urgent, why not buy stock of Apple and leave it? When you get the dividends or it grows, it booms, you now remove the profit over time to now buy the phone you want. That way, you have an investment that is working for you. And in the same vein, it is that investment that is paying for the necessary liabilities that you have. So it is the same money, but a different destiny that was given to it, attached to it. Please, does anyone understand what I'm saying? Are we with me? The chat is too silent. Are we following? Do we understand me? Okay, I can see Jonathan, I can see Femi, I can see Precious, I can see Lolia. It's okay, Deborah. Awesome. All right. Please, we can keep the chats, going so that I know that my network hasn't misbehaved or you guys are still with me, basically. All right. So the first shift that makes the investor's mindset is that you must move from consumer to owner. Then second shift is that you must move from quick money to compounding money. one of the greatest reasons why people lose money is because they want to make money quickly. And deep down in the core of the investor's mindset is patience. Ah, investment will teach you patience. But if you refuse to be patient, don't worry, you will learn loss in a terrible way. So you must actually move from seeking quick money to compounding money. If you ask people that made wealth, especially someone like Warren Buffett, who is one of the greatest investors of modern time, he he has shared his um, marketing strategy, or sorry, his investing strategy. And people, I think he was on a podcast one day, and someone asked him that, you have shared your investment strategy. Why is it that no one is copying it? He said, because nobody wants to make wealth slowly. And that is one of the major problems. Quick cash, quick money, quick returns. Everything eventually turns to quicksand. We sink fast. And so, taking a cue from someone like Warren Buffett, I have seen that real wealth is boring. For a long time, it might be you doing the same thing over and over and over and over again just because you want to compound. Real wealth grows quietly and steadily over time. So, if you find someone promising to double your money, if you find someone that is promising to double your money in 2 weeks, that's not an investment. Oh, they're about to teach you a painful lesson. And if you give them, oh, you will learn. You will learn. The school fees will be painful, man. If the returns are sounding magical, the loss will be televised. Anyway, that's just me trying to make it light. But please, two things that I believe can help you on this point is one, be more focused on the return of your investment rather than your return on investment. What do I mean? Be more focused on how you can get your capital back than the kind of profit that can come on your investment. That's one. Then two, what is two? If you don't understand what you are about to invest in, maybe you should wait a bit, gather more information. I have, I'm being recorded, so I can't say that. Um, let's move on. Let's move on. Another shift that must happen for the investor's mindset is you must move from being afraid, from fear to informed risk. Let me tell you the truth. Investment is risky. It doesn't matter what you eventually decide to invest in, whether it's agriculture, whether it's crypto, whether it's real estate. My dear, all investments are by nature risky. It's just that some are called low risk investments, some are medium risk investments, others are high risk investments. Something like crypto, majority of investments in crypto are high risk investments. And I say majority because I'm a bit knowledgeable in that area. So I know there are also safe ways to go about it. But majorly, crypto is a risky investment. So Rofiat is asking, move from being afraid. Move from being afraid to informed risk. And so I was explaining that every investment carries risk. but ignorance is like the biggest risk of all. So my conversation tonight is not to tell you to avoid investing or to avoid risk. No, it's to tell you that have an understanding of the risk attached. Then measure, count the cost, and only after you've counted the cost, like it is written, there's no one that decides that they want to build a mansion that will not first count the cost. So investment is like a mansion that you're trying to build. You must count the cost. And if you ask, okay, the cost is worth it. If I lose all this money, it's not the end of the road for me, or at least I can get my capital back. That is an example of you weighing the cost. Then you now make the move. Only take risks that you can survive. Only take risks that you can survive. Then moving on in our conversation to the parts that I can really call the blueprint in our conversation. So far, I've just tried to make a case for why you should invest and on the kind of mindset an investor has. Moving on to the core of the conversation tonight, there are 5 steps. And even if you would write nothing down, please take note of this. There are 5 steps I believe is core to investment. And the first step to investment is secure your foundation first. It is written that if the foundation be destroyed, what can the righteous do? So, first, secure your foundation. What do I mean by secure your foundation first? Before you invest a kobo, have an emergency fund as much as possible. Have an emergency fund. And if you're someone that you feel like, oh, you have limited income, you can decide to do, okay, this month's salary will go to, or a portion of this month's salary will go to investments, another one will go to this emergency fund, and be alternating it like that. But if your income is quite reasonable, you can begin to actually take out money for investment and at the same time be securing your foundation with emergency funds. So that's a double-edged sword. But all in all, you must increase your earning capacity. I don't think I should lie to you about that. Sometimes you are not extravagant in spending, you are just not earning enough. So you must find way to build assets that will bring income to you beyond your salary or whatever. And there's a lot behind the conversation of assets, but we cannot have that tonight. So I'm just going to continue. Like I was saying, before you invest a kobo, if it is possible, as much as it's possible, have an emergency fund. Let it be like 3 to 6 months, if possible. Investment money must be money that you can leave alone. Ah, don't go and invest your school fees. Don't go and invest your rent. Okay. I'm saying this, you will see that I'm emphasizing on certain things because I have experienced them firsthand. You're gonna learn, and you're gonna learn the hard way if you decide to not listen. No. Secure your foundation first. Investment money must be money that you can leave alone. And let me share one of the funny experiences I have in crypto. There's a In fact, several times, anyone that is in trading, whether forex, crypto, whatever, they will tell you about this thing. There are times that you buy a particular asset or token or coin, whichever language they use, or currency. You buy it. When you buy it, it either stops moving and just goes down, or starts going down and starts going down at a terrible rate. And you now decide, let me cut my losses. So because of course it's not necessarily investment money, it is your money that you want to use for other things, but you just decided to put it there, and you now saw it going down. You now did not want to lose all. You now removed it. Immediately you removed it, the demonic currency now starts rising back. And buying at that point no longer makes sense. I'm messing. It's nice to see you messing. So, step one, secure your foundation first. Go and buy food at home first before you invest in, for example, something like crypto. Second step is define your goal and your timeline. Define your goal and your timeline. Are you investing for a year? Are you investing for 5 years? Are you investing for 20 years? Short term goals need safer vehicles. Long term goals can carry more risk. So it is the timeline of your investment that chooses the vehicle for you and not your emotions. I remember a client, because I'm also a real estate consultant, like our moderator, Ms. Rofia. And I remember a client reaching out to me, and he wanted to get a particular land property. And then it was like I should be honest with him. And of course, I am always honest. Me, I try my best to always be, I try my best. In case you catch me lying, I try my best. He asked me that I should tell him the truth. I now asked him, okay, sir, what exactly is your goal? By the time he was done describing his goal, I saw that that property he wanted to buy was not the best fit for him. And I recommended another one for him, and he took that. By next year, he'll collect his money with interest and decide if he wants to reinvest it or not. Simple as ABC. Your goal, your timeline chooses the vehicle for you, not how you feel, not what is popular. Then the third one is you must actually know the vehicles of investment. I know you might not maybe want to go into crypto markets, but there's nothing bad in you actually having basic knowledge about the crypto market. I know you might not want to invest in stocks, but there's nothing bad in you having basic knowledge about stocks market. I know you might not want to invest in real estate, but there's nothing bad in thinking or researching about the real estate, knowing the basics. And so examples or some options of vehicles, I've already mentioned them in my conversation. One, money market and treasury bills. Go and do your research. They are basically low risk, they give modest returns, and they are good for parking short-term funds or even long-term funds, but good for parking short-term funds. Then second one is mutual funds. Another example, Rafa, is mutual funds. And again, you need to do your research on many of these things. First one is money market and treasury bills. Second one is mutual funds. So this is a case whereby professionals manage a pool of money. You gather money together, give it to professionals who begin to do investments with it. This is a good entry point for beginners. It's just that, in a sense, you are choosing to trust someone else. So that's a risk in that. Then another example is stock. And this is basically ownership in companies. So you're having higher risk, higher long-term reward. And for those that will make it in stocks, you must study. It will require you studying. Another example is crypto and digital assets. Again, very high potential, but it also means very high volatility. Don't enter without education and never invest more than you can afford to lose. Another example of an investment vehicle is real estate. And this is one of the vehicles that has been long term. In fact, if you look into history, you realize that real estate has been one of the makers of wealth generally. This particular vehicle of real estate has quietly built more steady wealth in Nigeria than almost anything else. So, land and property is tangible, it is appreciating, it is income generating. I won't be saying too much again on that point. Then the fourth step is diversify deliberately. Diversify deliberately. What do I mean by diversify deliberately? A point will come that you must not put all your money in one vehicle, no matter how sweet it looks. Diversification is how you make sure that one mistake does not become the end of your investment journey. So spread your capital. And again, remember I said at a level. It's not for you that has $10 in total low. Invest appropriately in one. Please don't, you can't put your eggs in many baskets if all you have is one egg. So I'm saying a point will come that you would have considerable capital. When that point comes, spread across risk levels. Have low risk investments, have medium risk investments, have high risk investment, so that if one fails, it's not the end of your life, it's not the end of your investment journey. Then the last step, which I think is very crucial, is somehow it ties to patience here, but it's more like start small, start now, and stay consistent. Start small, start now, and stay consistent. The people that are considered the best investors are not the people that have the most money, but more of people that are consistent. So if the person that is investing 10K monthly will embarrass someone that is waiting for 1 million to start, there's a saying, and I don't even know where I got the saying. It could be my thoughts. But time in the market beats timing the market. Time in the market beats timing the market. What that means is that instead of looking for the best place to buy every time, if you are consistently doing something, I'm having to use a lot of technical terms. If you're doing something we'll call in the Web3 word DCA, it is time in the market that actually beats timing the market. What it means is stop always looking for perfect entry, rather be consistent. So if you're open to put $100, for example, in an investment vehicle, that's your plan. Start with $10 and spread that $10 over 10 weeks. That's a concept called dollar cost averaging DCA in crypto Web3 world. So you are not buying a particular asset with all of your money, so that if it falls, you can buy it at that lesser price, and by the time it recovers a little, you have broken even. To take a lot of time to explain that for those who might not have prior knowledge in investing, and we do not have that much time. But I hope you've gotten the um what will I call them now? 5 steps in the investment blueprint. And just quickly, let me rush through a few mistakes that kills new investors. And I have mentioned some of them, but I need to re-emphasize them because I believe some of you are action takers and will take action from this point. However, let your action not lead you to a ditch. First one, investing in what you don't understand. If what you want to invest it in, you cannot explain it to a 12-year-old, don't put money in it. That's number one. Invest in what you understand. Second one is don't follow, or sorry, the mistake is following crowd noise. Let me tell you the truth here. And if you understand this particular point, it separates you from the masses. It separates you from the masses. By the time everybody is shouting about an opportunity, that's the best time to get out. The majority and early profit is almost, if not already gone, by the time everybody is shouting. So, in my little investment journey, and it has paid me many times, is that when I see people start saying that it's now majority of people saying buy, 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 it's that time that I'm either selling or looking for money and holding, waiting for the markets to fall, because I just do opposite of what the masses do, and it seems to benefit me. Don't follow crowd noises. It's the fastest way to a ditch. I won't say more than that. Third one is no exit plan. An LD investor knows that you must take profit. You must take profit. And what do I mean by you must take profit is that you can leave something that we call a moon bag, whereby you've taken your capital, you've taken your capital, you've taken a bit of profit, and you now maybe leave a little, that no matter what it does, whether you lose it all or it booms, it does not affect you anymore. Have an exit plan. Know when you will take profit and when you will cut losses before you enter, and not after you've entered. Fourth is greed. Ah, please, this is one you would definitely have to battle if you enter investment. And many people now disguise their greed as faith. So they will tell you that, oh, they are believing God for increase. They pick the trade and they are now praying over it. Believing God for increase is scriptural and I support, I agree. But ignoring wisdom and due diligence is not scriptural. So having faith and being foolish are not the same thing. When greed is controlling you, you are being foolish, no matter the language you're using to quote it. And for the sake, like I said, it's being recorded, so there are certain things I cannot say. But let me say just one. I had a friend that lost in his wallet. At some point, he had $200,000. Do the math. whatever conversion rate you want to do the math. $200,000 at a point, and he kept saying it will go up, it will go up for something that he didn't even necessarily invest money in. He invested time and got $200,000. So was like, no, it will go up, it will go up, and that is how he lost everything. That was greed. That was foolishness. Please don't be like him. All right, so I was thinking of giving an homework and making it practical for those who are interested. Before you sleep tonight, so that our conversation tomorrow, because we'll be having the tomorrow is third day of this FinProp class. Tonight, before you sleep, if you are interested, write down your investment goal and timeline before you sleep tonight. How much do you want to invest? How long do you want to invest for? That's one. Two, calculate your emergency fund target. How much do you think would last you for 3 to 6 months? Calculate it, write it down. Now, pick a vehicle of investment, either from tonight's conversation or from your personal studying, and study it deeply. Decide on your own. Study it deeply. Then, lastly, decide an amount, no matter how small, that you will commit monthly to saving, to investment, and automate it if you can. I will go through the 4 steps of the homework again. Number one, write down your investment goal and the timeline before you sleep tonight. Number two, calculate your emergency fund target. How much would last you 3 to 6 months if you stopped working at all? That is going to be your emergency fund target. Now, pick a vehicle from tonight's conversation or from your personal study and spend this week, this night, however long, studying it. Just one. Then, lastly, decide an amount, no matter how small, that you will commit monthly and automate if you can. And so this is where I'm going to be rounding it up and telling you that money not invested is you wasting potential. And every day you actually delay from investing, to you, it might look like safety. To you, it might look like you're standing still, but in actuality, you are falling behind. You don't need to be rich to actually invest, but if you don't invest, you can't be rich. So tomorrow, we're going to continue this class, and my super manager will be taking us into a vehicle that I've spoken about tonight, and he will drive us excellently well. So, same time tomorrow, 8 p.m., we'll be meeting. But before I hand over back to the moderator, let me emphasize your money is a servant that is looking for an assignment. Give it an assignment, please. That's all from my hand. Over to you, Ms. Rufiat.